right, that brings us to 2 o'clock Eastern. So I'll get started and we'll let people come in as they arrive. But I just want to say hello and welcome to today's Advisor Today webinar with Mattern Life and Symetra. My name is Kevin Velasquez and I'm a Senior Marketing Manager here at NAIFA. A few housekeeping items before we dive in, just so everyone knows today's webinar is being recorded. So if someone isn't able to make it or has to drop out early or just wants to watch it again, this recording will be sent out to everyone who registered within the next couple of days. In that email with the recording, we'll also include a survey. We'd really appreciate your feedback so we know what kind of content you'd like to see from webinars like these in the future. Also, if at any point you have a question, feel free to ask it using the Q&A feature and one of our esteemed panel will try to get back to you. And if not, we'll leave a few minutes at the end for questions that we didn't get to. And if you enjoyed today's webinar and want similar content, you can always watch past webinars on demand on the Advisor Today archives. Listen to our newly launched podcast, read articles, and more at at.naifa.org. So without further ado, I will turn the virtual floor over to Ryan from Mattern Life and Greg and Stephen from Symetra so they can tell you a bit more about who they are, what they do, and what we will be talking about today. So take it away.
Well, thank you, Kevin, and thank you all for your time here this afternoon or morning, depending upon where you're at. So my name is Ryan Mattern, and I'm the Advanced Planning Consultant here at Mattern Life. Very excited today to be joined by the folks over at Symetra, Greg Rohtstein and Stephen Patrizio. And I've known these gentlemen for years, and they become an incredibly valuable resource and partner for us here at Mattern Life. And just as a means of introduction, Stephen has been in the industry for about 34 years now, and with Symetra for 11 of those years. And Greg has been in the industry for 17 of those years, and at Symetra for the same 11 years along with Stephen. And Greg has held various roles in sales and distribution and is now the Assistant VP for their life product management. So I'm going to let Greg take us through kind of the history of AG49 back before when it started in 2015, and then through some of the updates and revisions, you know, AG49A and B and probably C, and within a few years, we'll probably go through the entire alphabet, and I'll have some brief comments at the end. But again, as Kevin mentioned, if anyone has any questions as we go along, please throw them into the Q&A chat panel, and we'll do our best to address them as we go along, or you know, open it towards the end as well. So without further ado, Greg, please take it away.
Great. Thank you, Ryan, and Kevin, and everyone else. Just want to, you know, we really appreciate you inviting us to speak to this group. We think it's really important to just give updates on, you know, the state of IUL and the actuarial guidelines. We've all seen all of these announcements come out recently about what is changing and will go into effect soon. But we also thought it was important to go through kind of the history, right? Because there's been a lot of changes to IUL and how they illustrate. So we'll start there, right? So if we look at the agenda, right, before there was AG49, it was kind of the wild, wild west of how to illustrate these types of products. There was no regulation telling people how to do it. Then we had the traditional AG49, AG49A, and what we are calling AG49B. Technically, it's called the revision to AG49A. We'll go into a little bit about Symetra's response to AG49B, and then also, you know, moving forward and how Mattern Life can help you and your business work with Symetra and, you know, make sure that you are, you know, up to date with all industry news. So again, just looking at the timeline. So AG49, pre-AG49 was before 2015. Right. IUL was first introduced in 1997. It's now the most sold product in the brokerage space. 2.7 billion in 21, over 3 billion in annualized premium in 22. I'm sorry, that should say 22. And, you know, it's still, we still expect, you know, growth in this space. We still think it's a strong product. The value prop of IUL is still there. No matter what regulation comes out, it is still a strong product for you to offer your clients. But again, prior to the original actuarial guideline or AG49, there was no uniform way to determine the maximum illustrated rate. So one company could decide to do a 10-year look back for their historical performance and come up with a certain number for their maximum illustrated rate. And another company with the exact same index, right, let's just call it the S&P, could say, well, we'll look back 25 years instead of the 10 or 20 years and come up with a completely different calculation as to how their maximum illustrated rate was determined. And for those of you that were selling in the early days and prior to that, you probably saw the difference, right? And we used to see illustrated rates in the 10s, 12s, 14s at times, I think, from certain carriers, and there was no real way to determine how they were getting to that number, right? So what happened was, people got together and said, the NAIC and others, we need to figure out a way to standardize the way illustrated rates are created and determined, so that at least everyone is on the same playing field from that regard. So Q, AG 49, but basically when Symetra launched our first product in 2017, we had to abide by the traditional AG 49, which I just mentioned about that standardized way of determining your illustrated rate. We had a persistency bonus. We were also really big into education and still are. One of our value props that we like to add, and Mattern has been a big part of that too, is we like to educate our advisors and on the product itself, right? We always want you to sell Symetra, don't get me wrong, but we also want you to know what you're selling and be confident that you understand how IUL works. So we developed something called IUL University, which helps educate brokers and consumers, for that matter, on the different kinds of products that were out there. Getting back into what AG 49, the traditional AG 49 was, again, it implemented a standardized methodology to determine illustrated rates for IUL. Basically, it said the maximum illustrated rate is determined now by averaging all of the annual returns for all of the possible 25-year periods for the most recent 65 years of S&P index returns. Although there was a standardized way to determine the illustrated rates, we still had some carriers do some funky things, right? So we had a lot of multipliers, a lot of black boxes, and things that we didn't know. So Q basically post AG 49A, and really what happened was carriers were either on this high leverage route where they had multipliers and bonuses, or they didn't, right? So what the NAIC had to come back in and say again is, we need to figure out a way to standardize this and make sure that these bonus accounts don't illustrate differently than non-bonus accounts. So they came up with AG 49A. And we'll move quickly through some of this history I see in the chat. I know we want to talk about moving forward, but some of the backstory is important, we believe, because it tells us why we got to this point here, right? Because without some of these industry concepts of multipliers and buy-ups, we wouldn't have been at AG 49B. These have spurned all these different regulations, right? So what you saw is that multipliers and buy-up caps and other enhancements cannot illustrate significantly better than other products or features. And then also, they limited the difference in par loan spreads. So when you illustrate a participating loan, as you know, you offer a spread. That spread used to be 100 bips. Now it's down to 50. Now, after AG 49A was adopted, we saw people move away from these multiplier bonuses and into the fixed bonus approach, right? So what you've seen is companies, along with Symetra, bring up new index accounts and introduce new index accounts, mostly volatility controlled index accounts. We offer one through Putnam that offers a fixed bonus and also a high participation rate. By doing this, we're able to illustrate an additional benefit to the client. And the way we can offer a bonus is these options, these index accounts, have lower option costs than a traditional S&P, right? So what we're doing is we're taking the savings that we have in our options budget that we would be putting into the S&P. By buying these cheaper options, we turn that into a bonus, right? So we're just giving it back to the client in the form of a bonus. But we're also starting to see some additional work in these products and features and without it's not necessarily a bad thing, but they're not, again, standardized. So we're still seeing people illustrating above and beyond illustrated rates. We're still seeing more leverage. So they came back in and they said, all right, we need to do something about this. We're going to create something called the benchmark index account and AG 49B. So benchmark index account was introduced actually in the original AG 49A, but now what it means is basically the new regulation that was adopted in December of 2022 that has to be effective on May 1st of this year, so about a month away, It says the new regulation says that no index account can illustrate above the benchmark index account, or the new maximum illustrated rate must be inclusive of any bonuses. So in today's world, if your maximum illustrated rate is 6 and you have a bonus of 1%, you're technically effectively illustrating 7. Even though your benchmark index account is 6, you're really illustrating 7. When it comes to AG 49B, what it's saying is you can't add that additional bonus to the 6%. You either have to lower your maximum illustrated rate to 5, and then you illustrate up to that 6, or you don't offer a bonus. So you cannot add any bonuses to your maximum illustrated rates. And those are determined by your options budget, something they call your supplemental hedge budget, which is a term that's inside the regulation, which is basically like the cost of buying those options and the amount of money you have available to buy those options. And that can be different by different carriers, of course. Every carrier has different profit limits and different things. So you will see some differences there. And then also it takes your entire IUL portfolio, and whatever your rate that you're earning on that portfolio, your maximum illustrated rate cannot exceed 145% of that number. Okay, so that is also another cap. So it's the lower of those two. So yes, you take your option costs and your hedge budget, and that determines your benchmark index account. But if your portfolio rate is not returning at a high enough rate to reach that maximum illustrated rate, you cannot illustrate at that level. So it's the lower of those two items, 145% of your portfolio rate or your option cost and hedge budget that determine your benchmark index account. As I mentioned, companies must make updates by May 1st of 2023. That is if you need to make changes. Not every carrier is going to have to make changes. If you don't offer any sort of bonus or volatility control account other than S&P, you may not have to make any changes to your product. You certainly can, but you don't have to. Again, similar to what happened with AG 49A, these changes do not apply retroactively, and it's only on contracts that are deemed sold on May 1st or later. So at Symetra, what we're considering sold is the date of the application is signed. So if your application is signed on May 1st or after May 1st, you have to comply with these new regulations. If you get an app in now that is signed today, let's say, even if it doesn't close by May 1st, you don't have to comply with the new regulation. And that was similar to the way that AG 49A took place. And what we're hearing in the industry is that that's kind of where people are at. There's no standard to what sold means. So you are going to have to work with Mattern Life, and I'm sure they're getting a list of all their carriers as the announcements come out that will tell you what sold means at each carrier, because some will have different definitions. But what we are seeing is we're starting to see some of these trickle out, right? Not everyone has made an announcement. We haven't formally announced what we're going to do just yet, but I can tell you that we are looking at all of our strategies. We're looking at the current interest rate environment. We're trying to figure out what we can do to provide customer value. Again, work is underway. We will be launching new versions of both our AIUL and PIUL on April 28th. What we don't see right now, at least, is any quick fix or pivot by the industry. As I mentioned, when AG 49 first came out, you saw the industry pivot to these multipliers and buy-up accounts, right? You don't see those many anymore. They might exist in the contracts that you have sold in the past, or they're in the background. They just don't illustrate as well. But when AG 49A then came out, you saw people pivot to, or carriers pivot to, the fixed bonus approach. Okay, we don't see a quick answer necessarily to the AG 49B, right? So we're not seeing a lot of new products being filed. What we're mainly seeing is illustrated rates change, potentially new index accounts. And one thing we want to make sure is clear, the products themselves are not changing, okay? This is truly an illustration regulation. Right? The regulation tells you what you can and cannot illustrate. It doesn't mean the policy can't perform like it is currently illustrated on May 1st, right? So everything that you've sold or anything you're selling in the go forward, it's all based off of an illustration regulation. The contract itself isn't changing. So if you have a cap of 10, the client can still earn 10 on that segment, right? If the company offers a bonus, you can still get 10.75 on a capped out contract or whatever it might be, right? So we want to make that very clear that it is truly an illustration change. It's not a product change. So we do feel like that IUL still has a very strong story and still has a value prop that makes sense for a lot of customers, right? So there have been people throwing out, I've seen on LinkedIn and other places, oh, income's going to drop 30, 40, 50, 60% on when 1849B comes up. Well, illustrated income may drop, okay? But that doesn't mean real world income drops, right? Because we all know that illustrations are good for one day, the day that they're signed, basically, right? We know that after the policy gets put in force, you're going to be needing to work with Mattern Life and others to get in-force illustrations and constantly be working through your contracts, because those illustrations, again, are truly projections. They're not, it's not necessarily real life. And again, the product is not changing, just the way we illustrate them. As I mentioned, Symetra will be launching new AIUL and PIULs on April 28th. We're not going to have any major pricing changes inside of our contracts. We are going to be making updates to our caps, pars, and bonuses. So participation rates and bonus rates will actually be changing. And I can tell you right now, they're going up. With the interest rate environment we're in is allowing us to, financially justify, raising caps on products, which is a good news story. We're going to be adjusting our fixed rate. Obviously, you'll see an increase to our maximum illustrated rates because of those cap and par rate increases. But really, the overall story will continue to be anchored, which we try to be, very simple, low charge, and as I mentioned, index choices that provide real customer value. It's something that, I think, and Stephen, correct me if I'm wrong, we offer 7 index accounts, 6 of which are uncapped.
Correct. Yeah.
So, we have some real upside in our product and bonuses, and Ryan and Chris at Mattern can really help you, take a deeper look into that. And Stephen and I are obviously willing to help also, with Ryan and others. But I think what you're going to see here over the next, 4 weeks, it's really crunch time, is you're going to start seeing some announcements trickle out from other carriers. You'll see some cap and par rate changes. You'll see some illustrated rate changes. A competitor just released an announcement, I think it was 2 weeks ago, where they just effectively netted out their bonus so that they illustrate the same rate, right? They had just for example, they had a 5% illustrated rate and a 50 bip bonus. So they went to 4.5, so that they still illustrate 5, right? That's what we think is gonna happen here. We could see some, Ryan mentioned this at the beginning, right? We don't see this being the last version of AG 49, whether it's B, C, D, E, F, whatever it might be by the time they get this right. Eventually, I think what will happen is we'll see a whole new model regulation. The illustration model reg will be opened up at some point and completely rewritten to include index universal life. When it was originally written in the 90s, IUL didn't exist. So we didn't have to think about maximum illustrated rate and benchmark counts and things like that. So we could see something like that happening or starting in the near future. That's a much larger undertaking than changing an actuarial guideline. We're talking probably 2 or 3 years minimum to rewrite that regulation. Things don't move fast in this industry, as you all know. And certainly something like this will have a lot of voices and a lot of cooks in the kitchen, really, to make sure that it gets done and done the right way. So I don't see this being as major, I don't think, as AG 49A was in the way that it affected illustrations. And that could be a combination of a few things. I think carriers have been expecting this for a while, right? There's been rumblings about this regulation change for the last year plus, almost since AG 49 came out in 2020. So we were kind of prepared for what it potentially would be, and then interest rate environment is a pretty good one right now for our industry, right? I mean, you don't want to be necessarily taking out a car loan or, a new mortgage at this time. But it's, from a carrier perspective, the higher interest rate is helping us and allows us to offer and pass that benefit on to your clients, right? So at least at Symetra, we're able to, like I mentioned, increase our caps, increase our par rates, right? Where not every carrier can do that. But we do think that we want to provide that value to customers when we can do it. And it's always good when you can deliver good news, right? But I do think that as you're looking at AG 49B and you're reviewing all of these things, the biggest thing here is the products aren't changing. You still want to focus on a simple, low cost, strong chassis of a product, because the illustration itself and some carriers may look better than others, but you also need to look at the mechanics of the product and how it's built, right? It's not always it's not always one of those things where it's not always the best illustration is the best product. You have to look underneath the hood. So I'm going to turn it right back over to Ryan, and he's going to give you a little bit more on how Mattern Life can help you and Mattern Life can work with you to help grow your business.
Thanks, Greg. If you go to the next slide. So yeah, just some additional comments and piggybacking off of some of what Greg had mentioned. This is nothing more than an illustrative limitation. This is not how policies are going to perform in the real world. And that's something all of us are aware of, right? We know that if we illustrate an IUL at 6%, it's not going to return exactly 6% each and every year for the life of the policy. That's pretty much a mathematical impossibility. But same idea here. So an illustration is just that. It's a hypothetical assumption. We need to make the clients really aware of that. So to get them more comfortable with the policy they're buying, we may have to dig a little deeper into the underlying features, as Greg mentioned, the riders, the different indices that each product offers, perhaps a deeper understanding of how the internal charges and expenses work within the policy. And I will say that, Symetra does have some of the best, maybe that's the wrong word, maybe lowest charges and fees in the industry, but that's where we can help, walk you through those policy features a little deeper and get your clients a little bit more comfortable. But some of us, probably remember a time when policies had to be sold with nothing more than a rate card, right? So you couldn't rely on an illustration. You had to get the client comfortable with the policy, the features rather than a bunch of numbers on a ledger. Now, I'm not saying we're going back to using rate cards, of course, but I actually think this will be a good thing in the long run. I believe that it will be helpful and will increase client retention. They'll have a much better understanding of what they're buying. They're more confident in their decision. And they have a better idea of how those policies are actually functioning. But along that same line, we might see an increased need for policy reviews, which is something that we should all be doing anyways, right? But maybe we're a little bit more proactive in that area. This is certainly something that Mattern Life could help to facilitate, gathering all of that data for you and work with you to review the policy and make sure it's up to date, make sure it's being served and it's serving its intended need and all of that. And as a side note, and not taking anything away from anyone on the phone, but if you're working through Mattern Life, we're more than happy to jump on a call with you along with your client and have that discussion when that time comes and go through their policy and do a policy review. So we realize there needs to be a comfort level there, of course, but the option is out there if any of you would ever need that. And that doesn't apply to just this. That support would be there for you across the board, whatever the case may be, through Mattern Life. So, but getting back, it's going to be useful for the clients to see how those policies are actually performing in the real world versus just an illustration that may have had somewhat of a limitation at the time of sale. And that will also help with client retention as well. And now, no doubt there will be some concepts and ideas that may be affected if we're utilizing an IUL with some type of limitation. So your life insurance and retirement planning, Greg touched on it before, your LERP sales. So for obvious reasons, if the illustrated income is, it might not look as appealing from an IRR standpoint, relatively speaking. So if a client's willing to buy into a LERP concept when being shown 50,000 of income on the back end, but now would balk at being shown 30,000, well, they're kind of buying into it for the wrong reasons. So for that, we need to really get them comfortable with the ideas, the concepts, and not just a bunch of numbers on a ledger. And again, that's where we can jump in and help to discuss those cases as they come up. You also have your split dollar and premium financing designs that could also be affected. So those concepts where we might, be utilizing the cash value of the life insurance policy as a rollout strategy. So, for example, in your financing designs, where we may be able to show a rollout and say year 15 to pull cash from the policy and repay that lender, we might now have to wait until year 20 from an illustrative standpoint. So if the client is uncomfortable with that, or perhaps we show an alternative rollout strategy like a grantor retained annuity trust, a GRAD. to get them more comfortable with other options, keep them engaged at least and not lose them. But with the understanding that we can still use the cash value and the timing of the rollout will certainly be dependent upon real life performance and not what we can show in the illustration. So, but generally speaking, we shouldn't be talking about these concepts any less. They're still very viable. We're just going to have to look at them perhaps from a different angle or position them in a different way going forward. Greg, slide. So before we get into questions, and there's one I'll address here at the end, but just want to take a quick second to go take you through some of what we're doing here at Mattern Life. So you see here some of the kind of the bread and butter of our platform. So from start to finish, it really is just a digital journey that begins with the client intake, the underwriting assessment, moves to the quoting process. And one of the things that are pretty neat here at Mattern Life is, you can access quotes yourself. And for example, if you have the client's health info, like their blood pressure, family history, their driving record, things of that nature, you can input that all into the system here. And that feeds directly into the carrier's underwriting guidelines. And then we'll spit back, the most likely health rating for that client. So it certainly helps with the field underwriting on the front ends. And, or you could simply just, you choose your standard preferred bests as you usually do. So you still have that option. We also have access to myself here for any advanced case design, as I mentioned before. So from your simple key person cases all the way up to your private split dialer and all things in between, like your policy reviews that we can certainly help with. Again, as I mentioned, we don't mind getting on the phone with yourself as well as your clients, their CPAs, their attorneys, whoever it might be, to help move these cases along. So, eventually we'll get into the app submission. The application process is all digital as well. You can pull up all the necessary items as you're quoting if need be. So you would see when a case goes from review to being quoted to any outstanding requirements being needed and so on. What you would see here right in front of you is your personal dashboard. So you can see everything through the entire process from the initial review to case management to illustrations. So, how many times have we deleted an email with an illustration or need to go back and find one from a month ago to get some updated numbers run? Well, here the quotes are all uploaded to a dashboard and can be accessed at any time. So it's all electronic. So everything's right at your fingertips, the illustrations, the application. We're building a concept library of various concepts and ideas, white papers, blogs on AG49, for example, case studies, things of that nature to help along in the sales process. But what we're providing here is a faster, more simple process from start to the eventual policy issuance, the approval, the delivery, the commissions, and support on the back end after the policy is enforced if need be. So if anyone has any questions on Mattern Life, wants to take a deeper dive discussion, certainly give us a call. But with that, we'll open up to any questions that anyone may have on AG49. We'll check the Q&A panel quick, but certainly feel free to throw your questions in there and we'll address it. But thanks again, everyone, for your time. We certainly really appreciate it.
Yeah, so it looks like, thanks, Ryan. It looks like we do have a question from Larry in the Q&A. So with hundreds of FMOs, with hundreds of Smart Life reps, why Mattern Life?
Yeah, as I just mentioned, some of the things there, again, it's just a digital from start to finish, from everything from the client intake, bringing in all the client details to the underwriting assessments. Everything is digital right there at your fingertips. It's in a matter of seconds. But we also have live bodies here that we can have those discussions if you want to take a deeper dive. Everything doesn't have to be digital, of course, but we have everything on the digital side as well as some of the access to myself for advanced case design, things of that nature. So everything from A to Z, everything is really just in one place for you, all on one dashboard and everything of that nature. So really just trying to be, as we say, tech forward, but still very much advisor centric.
Great. We also have another question for the group. Do you see any carriers making actual changes to their products or just changing how they're illustrated?
I mean, I can jump in from what I'm hearing at least. We haven't seen any new filings or like new product launches necessarily. So it mainly seems to be illustrative changes. Could be cap and par rate changes, as I mentioned, just maximum illustrative rate changes, or index changes. But we haven't seen anything major. The one spot which AG49B did not talk to is the participating loan leverage and spreads. So when we went from original AG49 to AG49A, they lowered the spread on participating loans from 1% down to 50, 0.5, or, half a point. And they didn't touch it in the AG49B space. So this could be somewhere we see some product changes happen. I actually did hear of one carrier file something with regards to like a bonus on participating loans, but they don't plan on implementing it at least at launch. But that could be where we see some changes and some things happening, but nothing as of right now that we're aware of. And I don't know, Ryan, or if you've heard anything, or Steven, but that's all I've heard.
Yeah, same thing here. Yep. But again, as we stress, and as Greg talked about and I talked about, again, it's just an illustrative limitation, not really a change to the underlying products, features, anything like that. It's just just a limit as to what we're actually able to illustrate from a crediting standpoint.
Great, thanks, guys. I'm not seeing any more questions, so no one else has anything. Just a reminder that this session is being recorded. We'll send it out to all registrants. So if you missed anything, you can watch it on demand, and feel free to reach out to Ryan, Greg, or Steven after the fact if any questions come up. But other than that, we do have one more question. With increasing rates, do we expect caps to rise?
Yeah, I mean, I think we can expect that from certain carriers. As I mentioned, Symetra plans on passing on those better rates to their clients in places we can. So I can only speak to what Symetra is thinking, but we could start seeing some cap increases. We've already seen a few this year, so from some of our competitors. So I would expect to see more, but it's not a guarantee by any means. You don't know what behind the scenes they have in their old block of business or other investments. So you can't guarantee that will happen, but we definitely could see some of that happen on a go-forward basis, especially if rates keep going up.
Yeah, agreed. And we don't know all the carriers are going to be doing here. We don't have they didn't have disclosed any. Some of them didn't disclose what kind of rates we will be looking at going forward. But yeah, just in general, I think that would be a natural, logical thing is for them to certainly raise their caps as rates go up. But we'll certainly see in the coming weeks here.
All right. Once again, thank you all for coming. Thank you, Ryan, Greg, and Steven for participating and leading today's webinar. We'll get out of here a little bit early, so enjoy the rest of your afternoons, everyone, and thank you all for coming.
Thank you.
Thank you.